Advisory services offered through Alpha Capital Management, LLC, an SEC-registered investment advisor. Alpha Capital Management, LLC, and SWAN-Capital are independent entities.
What your money would say. Andrew McNair. Money Talks. Are you listening? Money Talks. Are you listening? Money Talks. Are you listening? What your money would say with Andrew McNair.
We're live here on What Your Money Would Say. I'm your host, Andrew McNair. And for the next 30 minutes, every Saturday from 12:30 to 1 o'clock, we'll be taking financial chickens and making them financial swans. And at SWAN-Capital, my wealth management firm, and What Your Money Would Say, we believe as a retiree you should sleep well at night. And that's what a SWAN stands for. And we're going to talk about a topic today that as a retiree, many families just overlook. And I simply believe it's just a lack of education and a lack of digging in to make sure that their family is protected from this this risk that we can avoid if we catch it early. And before I do that, and before I bring on my guest, I want to share with you a few upcoming events. We have a veteran benefit workshop where we're going to talk about a benefit called Veteran Aid and Attendance here in a few assisted livings in town. And you can check out our website at swan-capital.com and check out our upcoming events. We constantly post the multiple workshops we hold every month. So you don't want to miss our upcoming workshops where we share with families how to receive up to $25,000 a year tax-free from the VA to help offset these assisted living, home health care, and skilled nursings. And this could be a great benefit for an elder parent if you are part of the sandwich generation that I commonly refer to on our show. But the topic I want to talk about is sometimes a morbid conversation that no one likes to discuss, not if you're young or you're old. And that's the topic of life insurance. But I would feel that I was not being a good financial advisor and a good wealth manager if I didn't discuss life insurance with my clients. And life insurance is not the only investment. It's not the only savings account. It's not the only insurance you should own. It's part of an overall financial plan, and it needs to make sure that it protects your family. And, you know, doing what Joe at the water cooler does, it not necessarily translates to a good financial plan for you because he may have kids, not have kids, may care about leaving a legacy, may not care about leaving a legacy. And today we're not going to focus on the type of life insurance that's right for you, because what I like to say is, you know, God forbid when you're on your deathbed, when some client asks me, you know, is my family protected? They never bring up what kind do I have. They bring up Andrew, is my family protected? And as long as I can answer the question, yes, you know, we've made the precautions to make sure that your family's protected, then I feel like I've done a good job. And Benjamin Franklin really summed it up. He said, you know, there's few things that we can escape in this world, such as death and taxes. And we commonly talk about taxes on What Your Money Would Say, and we're going to leave that to another day. But we're going to talk about death and how do you make sure that you leave a legacy that you planned on, and you don't have it, you know, get sucked away by the living expenses for your spouse. And I want to bring on Tim Von Ebers, and he's from Ohio National. His day-to-day job is constantly consulting financial advisors and wealth managers like myself and making sure that they have the right type of insurance for that particular situation, and also making sure that they have the right amount to make sure that that family is covered. So, Tim, welcome to the show.
Well, thank you for having me, Andrew.
Well, I've been looking forward to bringing you on because of the 25 years of experience. You've actually, you know, helped, you've been at the table with clients, and you've also worked for the life insurance company, so you have a lot of expertise to bring to the table. But if you are just tuning into What Your Money Would Say, and you're saying, well, Andrew, you know, I have a few questions about life insurance and my situation, you can always call the show live at 478-3116. That's 478-3116. Or if you say, Andrew, I want a one-on-one. I want to make sure that my family's properly protected. You know, I don't want to be sold more life insurance, but I do want to get a second opinion to make sure that my family's protected and that we're not overpaying for a life insurance because rates are down. Give us a call at SWAN-Capital at 850-380-9558. That's 850-380-9558. It's a no-obligation, 45-minute free consultation. Now, before we jump into the types of different kinds and the pros and cons, Tim, let's talk about insurance. We commonly buy multiple different types of insurance. You can kind of list off, if you will, Tim, the different kinds of insurances we buy, and some of them are worth it, some are not. List off a few of us for us, Tim.
Well, I've never sold them, but obviously we have automobile insurance and homeowners insurance. We have those pieces of property to insure. The things that you and I have always helped clients with are things like disability income insurance, if someone were to get sick or hurt, to replace their income. And then, of course, life insurance, the topic for today.
And also long-term care insurance, and we commonly talk about that on What Your Money Would Say. We are very quick to make sure that our home is protected from, God forbid, burning down, or as we know from Hurricane Ivan, getting blown away. And we also are very quick to make sure that our $25,000 car is protected. We keep that baby polished, and we make sure that if, God forbid, someone wrecked into it, well, we're going to get that thing replaced. And we even have insurance on our TV, just in case a power surge blows that thing out, and now I don't have a 60 inch screen TV anymore. But when we talk about life insurance, it seems like many families kind of avoid it, and it's kind of sad because it needs to be discussed, and just because we don't discuss it doesn't mean the need grows away. But I want to talk about, how much do you need to have? Many Americans are commonly underinsured or walking around underinsured. How does someone determine how much life insurance they need, and how have you seen some of their methodologies over the last 25 years?
Well, I think quite often people don't have a scientific formula to have chosen how much life insurance they own. I think that it's generally a number that is kind of plucked out of the air that sounds good. Now, if they have a good advisor, that advisor might have done some sort of needs analysis. Needs analysis done the correct way, can work. But a needs analysis is also a little bit like admitting to your client that this life insurance is a bitter pill to swallow, and so let's figure out how little medicine you need to take just to get better. And so it does allow clients to kind of rationalize away the amounts. But the fact is this: life insurance companies won't over-insure your life the same way your auto or homeowners policies won't over-insure those pieces of property. You wreck your Chevrolet, they're not going to give you Mercedes-Benz money for it.
Absolutely not.
So the operative question is this: if your 4-bedroom house burned to the ground, how much of it would you want replaced?
That's a fantastic question.
Wouldn't you want all 4 bedrooms back?
Yeah, if you can afford it. And I phrase that question when I'm sitting down with the clients. Let's say the wife makes $100,000 and she's the breadwinner. When I say, well, how much percentage of this income do you want to protect? A lot of times, the other spouse will, chime in and say, well, actually, I want 130%. I think she needs a pay raise. I've been pushing her to ask for that raise for the last 2 years. When is she going to ask for it? But so usually we want at least 100%. But some families don't understand that it takes a lot to make sure that $100,000 income or a $50,000 income is protected. And you're right, they choose it haphazardly. They may have $500,000, and it sounds like a lot. But if you're trying to protect that income, it's really, why so little? Because go ahead. When
you think about life insurance as a lump sum like that, $500,000, it does sound like a lot of money.
It's $500,000.
Yeah, it would be if it were a lottery winnings, if it was windfall profit, if you were still around to earn an income. But when your income goes away, that $100,000 income goes away, and you replace it with a one-time check for $500,000, and that fund, you realize, is the fund out of which your wife and children have to live the rest of their lives. It's not a lot of money.
Right. And even as little as for a retiree, once your spouse passes away, you're going to pick up the Social Security check of that person. So let's say your Social Security's $1,000 a month, $12,000 a year, and they pass away, and you pick up the higher of the check, and you lose yours. You just lost out $1,000 of a month in income. That's $12,000 a year. how much income would it take to, how much assets would it take to generate that? If you take back to that example of the the couple making $100,000, if they're making $100,000 and they get a check for $500,000, and they come to me and say, well, Andrew, I'm glad we have at least $500,000. What can we do to provide income? Well, the best I can do is maybe 3 to 4% because if I did any more, they will spend down the principal. And so now they're used to living on $100,000, but on Friday, when they passed away on Monday, they have to live on $20,000. It's hard to adjust, and that's why you see so many widows suffer financially.
Well, and I would say that that's a good rule of thumb for your listeners is to take the lump sum amount of life insurance they own on their life and translate it into the type of income it would generate if it were invested at that 3 or 4%. I mean, $500,000 is the equivalent of $20,000 a year in income.
And we're not talking a lavish lifestyle. Even if we provide the $20,000, I'm really undershooting it for my client because that's not taking into consideration cost of living. That's saying we live in a vacuum and I can give you a $20,000 check for the rest of your life and that's all you'll ever need. You need that to increase with inflation. But back to what we were talking about earlier, the life insurance company will never give you more life insurance over that mark. And you can talk about some of the guidelines they use, Tim, to determine based on your age.
Sure. Yeah, life insurance companies have determined, given your age and your income, what multiple of that income you'd have to put in the bank today to fully replace that lost stream of earnings. So ideally, just like we'd want our 4-bedroom house completely replaced, we'd want our incomes completely replaced. That's the ideal world. And so that's, say a 40-year-old that earns $100,000, well, it doesn't matter what they earn, a 40 to 50-year-old, based on general life insurance industry guidelines, could qualify for up to 20 times their annual income in life insurance.
So you're talking about if they're making $100,000, that's $2 million. So if you're just tuning into what your money would say, I have Tim Von Ebers from Ohio National, who consults wealth managers and financial advisors like myself, make sure that our financial clients are not only protected, but also have the right type of life insurance for their situation. And he was just sharing with you, how do you determine how much life insurance is enough? If you're making $100,000, one of the easiest general rules of thumb, just to make a conservative estimate, is to take how much income you need, and at a 3 to 4% interest rate, how much it would take to equal that income. And if you're saying, well, Andrew, that's just too much math for me, I need some help, call into our office for that free 45-minute life insurance assessment to make sure that you're properly protected. And we'll give you a second opinion, so maybe we could even save you some money on the term insurance that you're paying for. Tim, how much would that $2 million, that 40-year-old making $100,000, how much would that cost?
Well, I think people are surprised, when they find out how little money it would actually take to solve that problem. A $2 million term life insurance policy for 20 years on a 40-year-old is about $100 a month. I mean, it's less than their cell phone bill, certainly sometimes less than even their cable bill to solve, a significant financial problem.
Wow. I mean, I pay Verizon $134 a month. So,
right.
$100 would make sure that you can sleep well at night. And at SWAN-Capital, that's what we help retirees do, is sleep well at night. And $100 for a 40-year-old, if they're in good health, that's nothing. And that's especially when you're making, $100,000. That's less than that's about 1% of your income or less. So we're not talking about a lot of money. But let's jump into the types of life insurance. I always share with families, forget the kind. The media outlets, the news always focuses on what type of life insurance to buy. And that is not the problem. The problem is making sure that you're properly insured. But if we want to talk about the types, I give families the analogy. There's no bad type of life insurance. Term is not better than whole life. Whole life is not better than term. It's just right for the different situations. And you got to determine what your situation is. And the analogy
if these products were bad, regulators would legislate them away, wouldn't they?
That's exactly right. And that's what a great point. And the analogy I like to use and determine which product's best for you is buying a home. renting is not a problem. When you're going to college and you're, majoring in mixology, you don't want the hefty payment of a mortgage payment and all the stresses of, insurance and cutting the lawn and all that fun stuff. You just want the basic, I want to pay month to month and I want to pay for this coverage I need. Same thing with the term insurance. It just fills the gap during the time. So if you'll talk a little bit about how term insurance works and the pros and cons of it, Tim.
Sure. Term insurance, as many people probably already know, is just pure death benefit. They figured out how many 25-year-olds are going to die statistically. They know what they need to collect from all of those 25-year-olds to make good on the claims of those of them that don't make it. But because more 53-year-olds like me die than 25-year-olds statistically, the term insurance rates go up as your odds of dying increase. And back in the day when I started in the industry, there was only one kind of insurance. That was what was called yearly renewable term, and it started out low and crept up a little bit each year. And I could keep it for as long as I could afford to pay those premiums, and they could never take it away from me. Within the last 25 years, those types of policies have been more or less replaced by what are level premium term policies that are good for 10 years or 15 years or 20 years, but that come to an end at the end of that period of time. And so you think about it, if the insurance company is willing to put $2 million of their money
for $100 for a 40-year-old.
Right. They're going to put $2 million up of their money in exchange for $100 a month of your money. What do you think they think the odds of your death are in the next 20 years?
Well, less than 1%.
Pretty small, right?
Very
so they don't really plan on paying a death claim. They plan on collecting all of your premiums. They plan on keeping all of the interest they earned on those premiums, and chances are there's not going to be a death claim payable. And the industry uses a study that was done by Penn State back in 1993 that studied life insurance, term life insurance policies, and determined that 1 in 10 policies survives the period for which it was written.
Wow.
And that only 1% of all the term insurance sold actually resulted in a death claim.
So 98 to 99% of term never pays.
Well, it just isn't in force when people die.
Wow. And that's what they're paying for. I mean, it's one of those things where it's life insurance is covering something that is going to happen. Like Benjamin Franklin said, death and taxes, we can't avoid those two. And if you're just tuning into what your money would say, I have Tim Von Ebers from Ohio National, who doesn't have really a dog in the fight. He doesn't matter if you buy term insurance or whole life insurance. We're talking about the types of life insurance. And my goal is not that you buy term or you buy whole life. My goal is that you're properly protected. And we're using the analogy of a home. You can rent a home, you can buy a home, and they're just better in different situations. But the first goal is to make sure that you're covered. And if you're not sure if you and your family are covered, I encourage you to sign up for a free 45-minute life insurance assessment where we give you a second opinion. Make sure that you're not overpaying for your life insurance. Make sure that you're properly protected. We're not going to try to sell you more insurance. We're going to educate you, and then you can buy it if you don't want to or buy it somewhere else, but at least you're educated. You can call the office at 850-380-9558. That's 850-380-9558. And so if you're just tuning in, 98% of term never pays out because it's not enforced. And I like to joke with them is really life insurance companies are in the money collecting business. If they knew that they were going to pay, $2 million on a 40-year-old, they probably wouldn't write them to begin with. So basically they collect your money on the big fat chance that you'll pass away, which is not likely over the period of time they write you. So it's kind of surprising, 2%.
Yeah, so obviously, if death were inevitable, they wouldn't make that trade. They wouldn't put up $2 million of their money in exchange for $100 of yours if death is imminent.
Right.
So to be fair, there are obviously a large number of those term policies that are converted during the term, converted to one of the forms of permanent insurance. So it's not just that they all lapse or that they all don't result in a death claim. Some of them are converted.
Yeah, which is great. And you just want to make sure that your term is convertible. Not everyone's term insurance is convertible. And sadly, they may pick up an illness or they, have a disease and they get diagnosed and they think that their term insurance is actually convertible when it's not. Or worse yet, I've dealt with situations where the beneficiaries weren't set up right on their life insurance or set up 20 years ago, and it was done to their ex-spouse. So you don't want some of those stories to be your story. And that's why I encourage families to sign up for that free 45-minute consultation or to make sure that you're properly protected. And we talked about how life insurance rates have been severely lowered. And give an example of that 40-year-old one more time, Tim.
Sure. We were talking about a 40-year-old and a $2 million life insurance policy, a $2 million term policy for 20 years, costing right about $100 a month, less than your cell phone bill.
Wow. And $100. Again, I pay Verizon $134, so I just can't fathom why a family wouldn't spend that to make sure that your family's protected and make sure that you can sleep well at night. I think $100 is worth the peace of mind to make sure that your family doesn't have to worry about that. And you can call SWAN-Capital at 850-380-9558. That's 850-380-9558. And if you're driving down the car and you just want to ask a quick question over the air about life insurance and maybe what type is right for your situation, give the station a call at 478-3116. That's 478-3116. Well, there's also another type that's kind of a hybrid of the type we're about to discuss, whole life insurance. But universal life does have its times where it's really needed, maybe like a guaranteed term. It can be used as that. But we don't have a lot of time to cover universal life. I'll let Tim use a few minutes to describe why it was invented and where its uses could be. But if you'll just cover universal life real quick.
Sure. Universal life was created back in the late 70s, early 80s, at a time when money market interest rates were at 15%.
Ooh, I wish those days were back, weren't they? That'd be nice.
Don't you? But it was an anomaly that was obviously not destined to last. But people were looking at that 15%, and they were saying, well, I have this traditional whole life policy that's earning 7 or 8%. So they thought they could cash those out, buy inexpensive term insurance, and invest the difference on their own. And so universal life was created, as a response to the insurance companies having clients surrender policies. They said, well, we'll do that kind of buy term and invest the difference for you, bundled into a policy called universal life. So in universal life, the underlying insurance is term insurance. It's subject to the increasing costs of insurance as we get older. And the insurance company then takes the excess premium above and beyond that term cost, and they funnel it into an account that accumulates. So it's a great kind of hybrid solution. Has premiums that are lower than they can be lower than a traditional whole life policy. But I think clients need to be careful to fund them properly so that they don't, these universal life policies don't expire before they expire.
Right. I saw many horror stories where families were, promised 12% in the universal life insurance or the variable life insurance, and it never made that. Obviously, interest rates continue to drop over the next 20 years, and they had to put more money into it, and it lapsed. And that was a sudden surprise, and it wasn't a really nice surprise for those families. Now, let's talk about whole life insurance. Tell me a little bit about the pros, and then we'll talk about the cons about life insurance, because for every decision we make financially, there's always pros and always cons. You got to make an enthusiastic decision based on both of it.
Sure.
And back to the analogy, term insurance is renting the home, and renting is sometimes necessary part of your life. But sometimes you need to buy a home where you can build the equity. People don't want to rent forever because they want to build that equity. So start off and tell us a little bit about the pros of a whole life insurance.
Well, I mean, your renting and buying analogy is good. To own a home costs more early on, right? It's more expensive than rent. The mortgage.
The outlay is more. The cost's not always more.
not. No, right. The outlay is more. So the mortgage payment is more than the rent payment. So whole life is like that, where the outlay initially is going to be higher. Now the cost is going to be significantly lower because over the period of that policy you're going to earn in cash values. But the pros are that whole life insurance has guaranteed premiums. It can't ever come back at you for more money. Guaranteed death benefits that you can't outlive. Guaranteed cash values. You can buy and pay them up over a period of time and have them forever. Unlike the rent, the term insurance, where if we stop paying those premiums, that coverage is going to go away.
And the landlord kicks you out. And as a retiree, you don't want that uncertainty. You want the guarantees. And another thing I like to always promote with the younger clients, term and invest in the difference is a great theory. The problem is it's a theory. And as I learned in college when I was studying finance, and I'd already had previous experience working in a financial firm, I saw that, theory's great, but when you throw people into the mix, people don't always do what's theorized. They do what their emotions drive them. So if they go into a 2008 and they were supposed to be doing term and invest the difference, they don't always invest the difference. They feel like they have troubled times, and obviously they do in a 2008 period, and they don't contribute, but when times are good like they are now, they forget to contribute again, and so the theory works potentially, but it's never used. So that's why whole life insurance can provide you a forced savings that if you know that you're not a good money manager, you know that you don't track every penny, and you know that you don't save as much as you should, it can be a good alternative. But for all those pros, there got to be cons, Tim, right?
Well, we talked about the fact that that initially it has a higher price. But that over time it has a lower cost. So there is going to be a greater outlay early on. It is not a great way to save or accumulate money in the short term.
Which is just like a house. I mean, who lives in a house for 3 years and then moves out? If you did that, that's not a good idea.
Right, you're not going to have a lot of equity built up in those first few years.
And a lot of closing costs.
Right, the same is true with whole life insurance. Companies have to set aside what's referred to as a legal reserve. They're having to set aside money to meet that future obligation because that whole life policy could be enforced for 30, 40, 50, 60 years before they have to pay a claim. So that's why cash value life insurance policies don't have a lot of cash value in the early years, is because they're setting aside that legal reserve to meet that future claim. But it isn't inflexible as some might think. You can skip premiums, maybe not the first 1 or 2, but certainly 3, 4, 5 years into a policy, if you find yourself temporarily unemployed, you can skip premiums. Have in the case of a whole life policy, have the dividends help repay that premium.
Right, and a lot of people don't know that. So if you're just tuning into What Your Money Would Say, we're talking about life insurance, and we're making sure that as a retiree, your family is properly protected. And there's so many different types of protected. Whole life is not better than term, and term is not better than whole life. It just depends on your situation and what's best for you. It's just like buying a home or renting a home. It's what is needed in that time. At the end of the day, you just want to make sure that you have a roof over your head. And the same is with life insurance. You want to make sure that your family has a financial roof over their head if you were to ever leave and check out. So if you're just tuning in and you say, well, Andrew, I want to talk to you one-on-one. I want to make sure that I'm not paying and overpaying for my life insurance. I want to make sure that my family's properly protected. I encourage you to call SWAN-Capital at 380-9558. That's 380-9558. I want to thank Tim for coming on and sharing with us his 25 years of experience in the life insurance industry. Thanks for coming on the show, Tim.
Great. I've enjoyed it. Thank you very much.
Well, again, I want to close with, if you feel like, it's just too expensive to afford the term insurance that your family needs, for a 40-year-old, $2 million could be as low as $100. I'm sure you can afford that peace of mind. I look forward to seeing you next time on What Your Money Would Say.